For much of my long and illustrious investing career over the past 2 weeks, the internet has trained me to believe that every red day is a gift. Stocks down, buy the dip. Stocks down more, buy the bigger dip. Stocks fall through the floorboard and into the basement. Well, apparently that's when you're supposed to back up the truck, go shopping, and start talking like Warren Buffett just possessed your body for the afternoon. And look, sometimes that is true. But I think a lot of investors are focusing on the wrong risk, because the biggest risk in a market like this is not failing to buy the exact bottom. It's being forced to sell near the bottom because your life got hit, because your cash was running out, and your portfolio quietly became your emergency fund. That is why over the past month, I just stopped buying stocks completely. Not because I knew the market would get uglier this past week. I seriously didn't expect it to get this bad. But because there were enough red flags that started to pile up, I thought, you know what? This is probably not the time to keep charging forward like a golden retriever chasing a tennis ball into the motorway traffic. So in this video, I want to explain exactly why I paused my buying, why I've been stockpiling cash instead, why that does not mean I've changed my long-term thesis and outlook on the market, and what I think investors should actually focus on when the market starts throwing chairs around the room. And I really think if you watch this to the end, you'll feel calmer, clearer, and a lot more certain about what actually needs your attention right now. Because I'm going to tell you exactly what I'm doing now and why, and more importantly, what I'm not doing. If it wasn't already obvious, I'm just a guy on YouTube. This is not financial advice. It's just my analysis of the market and the way I'm thinking about risk in my own life and portfolio. So first, the basic point. Over the past month, I stopped buying stocks. And I want to be really clear about why. It was not because I suddenly became bearish on things. It was not because I decided the economy is definitely going off a cliff next Thursday at 11:14 a.m. And it was definitely not due to any change in thesis on the businesses I already own. My thesis on my holdings still stands. These are multi-year ideas for me. Some of them I'm happy to let play out all the way till 2030. So there is no panic selling from me here. This is not a sell everything and hide in the bunker video, just as much as it's not a using moments like this to make generational wealth type of video. This is a capital allocation video, and those things are very different. This distinction matters because a lot of investors blur two completely separate questions together. Question number one, do I still like the businesses I own? And question number two, do I need to add more money to them right now? Obviously, those are not the same decision, and I think a lot of people treat them like they are. If the stock is going down, they feel like they're morally required to buy more, or that they're somehow betraying this hidden long-term investor code. I don't buy that, because this is the part people are silent about. Retail loves talking about buying lows. Hardly anybody talks about what happens when life forces you to sell near a low. And that, to me, is the real risk. The stock market feels very different depending whether you have time or whether you need cash. You see, if you've got a proper emergency fund, stable cash flow, and enough breathing room to let your investments sit there and look absolutely ugly without touching them, then a sell-off, while uncomfortable for sure, is just noise. It's just valuation movement, and honestly, it's just your brokerage app trying to ruin your breakfast if you open it up too often. I don't do that, by the way. But for all the different reasons this could happen, if your finances get tighter, if your income gets hit, or if the job market worsens, then your portfolio stops being an investment account and unfortunately starts becoming an emergency ATM for many people. And that is the danger. That is the whole point, because the market is a very forgiving place if you can wait. It is unbelievably cruel if you can't. Imagine it's like being on a long ocean voyage. If you've got fuel, a radio, food, and a lifeboat, then the rough water you encounter is still just rough water, but you can ride it out. If you don't, then every wave starts to feel like a personal attack on you. That is how I've been thinking about this period. Not as some heroic game of calling the exact bottom, although I've been accused of that, but as a question of resilience. Can I sit through volatility without being forced into stupid decisions? That is the real test. Now, did I know the market would perform this poorly over last week? No. That is not the claim. The claim is far simpler. There were enough warning signs to pause. Oil risk was still alive. Rates were still high. Growth was softening. The job market looked more fragile than many people wanted to admit. These are all the things that I've been covering on this channel over the past few weeks. But more importantly, it felt like the environment was deteriorating faster than the average investor was willing to acknowledge. So I just stopped buying. Not because I thought I was about to outsmart the market, but because when the road ahead starts to look foggy, icy, full of potholes, I don't think the intelligent move is to speed up and tell yourself that confidence is the strategy. Sometimes the right move is just to take your foot off the accelerator, and that is what I did. Now let's talk about cash, because this is where the whole thing gets practical. When I say I'm stockpiling cash, I'm not talking about notes stuffed in a shoebox under the bed next to my passport. I mean actual liquid capital, cash that is available, cash that is boring, cash that is doing what boring things do best, which is quietly make my life less dramatic. Personally, I already have 6 months of living costs covered. But now I'm actively building that up towards 12 months. Not because I think civilization ends next Thursday, but because I think the job market is getting less predictable. AI is putting pressure on certain roles, and the economy is slowing. And I'd rather have too much breathing room than not enough. And that cash gets parked in an interest-bearing savings account. So it's not just sitting there under a mattress eroding with inflation. It is liquid, it is earning something, and most importantly, it is there when I need it. Cash in this context is there to buy me time. And time is what stops temporary market pain, just like we're going through right now, from turning into permanent capital damage. Now, I've been seeing my fair share of comments on the channel claim that I'm being dumb and that I'm trying to time the market. And honestly, it's just showing me that they're just not watching the video and actually paying attention. No, I'm not trying to time the market, at least not in the way that lazy people usually mean it. I'm not trying to call the exact bottom. I'm not sitting here pretending I know what the market will do next Tuesday at 9:43 a.m. I buy individual stocks. That means I actually have to think. It means I have to decide not just what I own, but when conditions are good enough to add more capital to them. And if the macro backdrop is deteriorating, I do not think ignoring that is discipline. I think that is just intellectual laziness dressed up as stoicism. That approach is fine if you are blindly dollar cost averaging into a broad passive fund for the next 40 years. It's a completely valid strategy. But that is not what I'm doing here. I'm buying individual businesses. So if the environment around those businesses is getting worse, I think it only makes sense to actually acknowledge that, to think for myself and wait for better odds. Now, the other side of this is really important. Just because I stopped buying does not mean I've changed my thesis on the businesses I already own. And that part is crucial because I think a lot of investors see a falling price and immediately assume something must be fundamentally broken. Sometimes that is true. Sometimes the thesis really is damaged, but a lot of the time it isn't. A lot of the time it is macro pressure, valuation compression, headline risk, fear, de-risking, and the financial media doing what it does best, turning uncertainty into a smoke machine because panic gets attention and attention sells ads. So for me, there is no panic selling here. My thesis still stands. My time horizon still stands. What changed was simply this. I paused new buying until the macro backdrop stabilizes. That is it. Now, if there's one thing I want you to take away from this, it's this. You do not need to feel stupid or feel uneasy when the market starts sliding. No one enjoys watching their portfolio lose value. That feeling is completely normal. What matters is what you do with it. If your emergency buffer is solid, if you're comfortable with your holdings, and if your thesis is still intact, then a lot of the emotional chaos around you is exactly that, emotional chaos. It is the news media ringing the dinner bell for fear because fear keeps people watching. It is social media turning every red candle into the collapse of civilization because apparently nobody online is emotionally allowed to experience a correction without narrating it like the final helicopter out of Saigon. But if your life is stable and your buffer is real, you get to zoom out. You get to think. You get to choose. And that is the whole game, because the market only becomes truly terrifying when you lose the ability to choose. That is why I think the biggest risk to investors is forced selling at lows, not missing the exact bottom. So what am I doing right now? It's very simple. I'm not selling my core holdings. I'm not rushing to buy more. I'm building my buffer, I'm keeping the dry powder liquid and earning interest. And I'm waiting for the macro conditions to stabilize before I resume any of my buying. That's it. There's no heroics, there's no dramatic predictions. And I'm certainly not pretending that every dip is a divine gift wrapped in a red candle and hand-delivered by the investing gods. But rather, it's a calm understanding that preserving flexibility in a market like this may be worth much more than forcing a buy because the internet told me to dollar cost average or not time the market. So after thinking this through over the past month, my conclusion is pretty simple. The biggest risk to investors right now is not failing to buy at the exact bottom. It is being forced to sell at a low because you didn't separate your emergency fund from your investing capital. That is why I paused buying. That is why I've been stockpiling dry powder. And that is why, even as a long-term investor, I think caution can be intelligent without being bearish. So I'm curious what you're doing. Are you building a proper emergency fund that's separate from your investing portfolio, or are we YOLOing every dollar and dime into this little dip? Let me know in the comments. And if you want to follow the real decisions in this portfolio, subscribe. Thanks for watching and be safe out there.